To handle this, we have Speaker CA Neeraj Agarwal. Can I request the Chairman to escort the Speaker to the day? Please offer him a floral bouquet. Members, without further ado, I'll just take up the introduction of the speaker. CA Neeraj Agarwal is a FCA, LLB, BCom, SIA and CBA, USA. He is also a registered valuer and president of Bangalore Valuer Association, a partner of AAN and Associates LLP. Neeraj Agarwal is a fellow chartered accountant with over 12 years of diverse professional experience in valuation, taxation, auditing and corporate advisory. A registered valuer under IBBI for securities and financial assets. He is also a certified valuation analyst, social auditor and a law graduate holding multiple industry recognized certificates including INDAS. Currently leading the valuation practice at his firm with offices at Kolkata and Bangalore. Neeraj has successfully handled a wide range of complex assignments in valuation, including mergers, startups, intangibles, ESOPs, FEMA, INDAS, taxation, etc., statutory audits and corporate audits, tax audit planning. He is also actively involved in teaching microeconomics and valuation to aspiring professionals. He is serving as a president of Bangalore Valuers Association for 25-26. He was a special invitee to the ICAI Sustainability Reporting Standards Board. Neeraj Agarwal contributes through leadership thought through articles, webinars and seminars on valuation, social impact audit and regulatory updates. He is also author of the book called Agarwal. Right, so, with this brief introduction, I present before you CA Neeraj Agarwal. I would like to introduce the second speaker as well. Because the second speaker already is here. Members, we have another speaker, CA Ankit Marlecha. I request Chairman to please hand over a bouquet to him. So it's a privilege to introduce the speaker. Ankit Marlecha is a chartered accountant and an affiliate with the Association of Chartered Accountants Association, United Kingdoms. Ankit is a partner of Marlecha Sharan and Associates, Bangalore. Ankit has previously worked at Kincha and Associates and KPMG and special focus in the areas of tax consultancy, litigation and risk advisory services. With over 10 years of post-qualification experience, he has worked on assignments involving a range of domestic and international taxes and regulatory issues, litigation and consultancy services to various entities, including family trust, listed companies, as well as high net worth individuals. He has represented clients before various income tax forums and tribunals. Ankit has also co-authored articles on various topics in income tax published on tax websites such as Taxutra and has delivered lectures at study circles, Sikasa, etc. on the topics of income tax. With this brief introduction, we have CA Ankit.
Topic, which is new areas of practice for chartered accountants in ESG and BSR reporting. So first thing which I would like to ask all the participants, we use the term ESG and BSR, but can anybody tell me what is the difference between ESG and BSR, or are both the same? And if they are both the same topic, then why are we having two different words? Anybody from the participants can tell me what is ESG and what is BSR? Anybody? The wrong answer will not be penalized, don't worry. Okay, so I think I have to tell this. So see, ESG is a broader concept ESG is the global concept and BSR is one of part of a ESG, which is the reporting requirements by SEBI. So technically you can very well say that BSR is a part of ESG, ESG is the broader term. So when we say we are covering ESG, technically we are also covering BSR reporting, because BSR is type of reporting and ESG is the actual generic term which is used globally. Now we all have heard that ESG is shaping the corporate landscape, and more with the passage of time it will also come to impact MSMEs and all. So technically now also slowly and steadily it is seeping into the MSME culture. But right now, if you ask me, purely from a reporting point of view, BSR has been made mandatory for top 1000 companies. Can anybody tell me when I say top 1000 companies, what do I mean? Whether by turnover or something else? When I say top 1000 companies, it is mandatory for BSR reporting. Can anybody tell me? So it is by market capitalization. So SEBI has announced that top 1000 companies by market capitalization, mandatorily they will have to do a BSR reporting. So as CAs, we can always lead in assurance, compliance and advisory, even for the field of ESG and BSR. I will also cover this last point, which is even non-listed entities and entities going for listing are requiring sustainability report. So I'll give you just a brief example of one of the entities which I have just recently worked on. That entity is going for an IPO, and when it has filed its DRHP, it got returned back with a comment that SEBI wanted one sustainability report on one of its products, sustainability plus feasibility report. So you see, for these type of companies which are not even under my 1000 market capitalization, SEBI is asking for sustainability reports. So what SEBI actually wanted was, they wanted that the product, the money which they are going to take in, that money how are they going to spend? Whether it will have detrimental effect on the environmental, and how are they going to recoup the money? So even for companies which are going for IPO, sustainability reporting is coming into picture. So this is a very big area for all of us to capture. Now quickly, ESG means environmental, social and governance pillar. That means it has three major parts, which is environmental, social and governance. We will briefly cover all these three areas also. And like I told you, what is the difference between ESG and BSR? BSR is the SEBI's framework aligned with global standards for reporting. So actually what we are doing is, in BSR we report about ESG compliances, how the company has been sustainable, when the company has certain negative impact on environmental, social and governance. So difference between the both, ESG is a generic term and covers a wide area, while BSR is a term specific for SEBI reporting. Now why do you think ESG and BSR matter for CAs? You will say we don't have time to complete our audit, how we are going to do this? But we all know that what is happening with traditional practice. There is a very good area, there is a very good opportunity for all of us, and there is a lot of scope because this is a very niche area and a very new area in India. And in the coming future years, this area is going to become bigger. Now even if you see the BSR reporting of from 1000 companies, you will find that in a lot of time the sustainability of the BSR reporting is matching in the number of pages when you compare it with the annual report. So the financial part is being matched with the sustainability part. So if the companies are taking it so seriously, then you can very well assume that what is going to be the future. Focus on non-financial disclosures is increasing, like I told you. Investors deem ESG metrics, demand ESG metrics, risk management and regulatory compliances, growth of sustainability linked finance. Can you tell me why do investors are asking for ESG metrics of a company? What will they get out of it? So I tell you, especially India, it's in a nascent state, but in Europe and US, it has become very big. There are a lot of penalties, there are a lot of compliances which are being done in the European Union and America. And the investors, they don't want to invest in any country, any company which is not having ESG, which is not ESG compliant as per the global standards. Leave aside Indian standards, they are talking about global standards. So you will again see, and we will cover this in the later part, that there are certain standards which the companies are following, and these are global standards. So even though we have Indian standards also, the companies are mostly complying with the international standards. because they want to present it to the investors. So this is a big area for all of us. So we don't have to, when we are giving ESG reports, we are actually dealing with international global practices and not alone Indian practices. Now few of the areas which I have mentioned, and each area we will cover briefly, are the first one is ESG assurance and attestation. Independent verification of ESG metrics, alignment with ISA 3000. So this is a very big standard, you people should write it down. This is another basic standard which is done in sustainability reporting. There is an Indian equivalent of ISA also, but mostly you will find the listed companies, they will always mention that we are compliant with ISA 3000. Scope includes energy use, emission, ethics. Currently there is no mandate that who can perform these tasks, but these are generally preferred. Reasonable assurance is a key SEBI requirement now. So first thing, can anybody tell me BSR reporting who is mandated to do? CA, CS, lawyers, MBA finance, who are doing BSR reporting for these companies? Who will ultimately sign the report? Anybody? There is no right or wrong answer in this. Rest assured. Sorry? Yes, CAs are doing obviously. Only CAs? Sorry?
Social audit exams.
Social audit I will cover that, sir, but that is not linked with BSR reporting. It is not mandatory. So technically SEBI has come out with a very vague type of qualification that anybody experienced in sustainability reporting can do BSR reporting. Now that is a different task that people did not do sustainability report earlier, so nobody is experienced to do it. So there is no qualification. You can do it, anybody can do it. Preferably, why will CAs will have an advantage on BSR reporting, because you are already there in the audit domain. So you can always pitch to cover it. And SEBI initially the alignment was that only CAs will be allowed to do BSR reporting, but I think later on they changed their mind and they made it more vague that currently everybody can do it. So there is no specific qualification to BSR reporting.
Everybody needs some other function, either advocate, secretary,
So sir, this way what they have said is it is more on the right now because it is not nascent stage. It's the first year which will become mandatory. Last year it was voluntary adoption. So what they are saying is it is up to the company, which company will right now decide who they will give the BSR reporting to. So the company will take a call whether they are qualified enough. So anybody who is, suppose a sales marketing person comes and says give me the work, why will the company appoint them? Technically they will not come under the experience qualification.
In that case, engineers can also do it.
So engineers will have to be a part of BSR reporting. Why? Because, for example, I am not covering what is the format of the report, but there is a lot of input which has to be given. For example, how much water matrix you were using, what is the consumption of this item, what is how much pollution you have created. So even for us, CAs also we cannot we can put the numbers, but we don't know how to calculate those numbers. So you will need some in BSR reporting. You will need certain help from different individuals. It's a very wide area. So one person cannot say I will cover the entire BSR reporting by myself. Ultimately you will sign it off, but you will need engineers or somebody else's support, like energy auditor. Now if you see the last term, SEBI has said reasonable assurance. So this term has come from this year, which is called that there should be a reasonable assurance, because earlier what was happening was in the first year of adoption there was no assurance. People were just reporting it the first year. So anybody was reporting anything. There was very big companies who have reported. We did not have any. For example, if you are reporting on the employees' mental health being, there were companies which have reported that we have 5,000 employees and there have been no cases of any harassment or there has been no complaint, nothing. So this type of reporting happened in the first year. So now they are coming with a thing which is called reasonable assurance. This is what the professional will give. They will say that we are reasonably assured about this point. In that also, it is not 100%. BSR reporting is a very comprehensive framework. In that comprehensive framework, they have covered certain parts on which reasonable assurance has to be given by the signing professional. Now, like I said, that this is one of the golden standards of BSR reporting, which is called ISAE 3000. which is formally titled as Assurance Engagement Other Than Audits or Reviews of Historical Financial Information. This is issued by the International Auditing and Assurance Standard Boards, and it sets out all the requirements and guidance for conducting assurance engagement and subject matters such as sustainability reports, compliance with laws or regulations, controls, service organization and other information. In India, we have an equivalent to ISAE, which is called SSAE 3000. So they did not, the number and everything is same. Alignment wise also it is almost both the things are same. If you ask me right now, most of the companies they are mentioning both the standards and we are compared with both. Technically it is almost the same. The alignment is very near in both the standards. Now this is the big area, BSR reporting services. This is a key area which you can try to capture. Support in BSR preparation. Supporting in initial implementation of BSR reporting as and when they become applicable. Currently what I will give you a brief example, a live example which I faced. One company has approached us and they are asking that this year we are mandatory to do BSR reporting, but the auditor is asking that you prepare 2 years back reports also on a voluntary basis because they want to do a comparative analysis. So now we are supporting them for 3 years of BSR reporting. Because what will you compare the data with? So if I say this is the first year of me implementing BSR reporting, what will I compare the data? If I say I have used X amount of water this year, what is the comparative data for me? I have to do the previous year also. And then I can come to a conclusion that if the turnover was 100 rupees and I was using 50 gallons of water, now this year I have used 60 gallons of water but the turnover remains the same. Then as a BSR reporting person, you can ask why the number of gallons have increased. So, BSR reporting it is coming right now, but when you get an assignment, you will also have to do with the previous year comparatives also. So currently this is a live example which we are doing it for 3 years of the company.
One thing I would like to know.
Yes sir.
If reporting should be made applicable, where the issues are involved, why it is generalized for 1,000 companies?
So this is SEBI is actually implementing it slowly on a phased manner basis. Because if you see the first year reporting, voluntary reporting, it was absolute mess. Nobody had clue what they were doing. Any type of data was uploaded. Because SEBI was also not clear with all the framework. There were a lot of small issues in SEBI's reporting framework also. So they are also coming out with a very in a phased manner. And the issue is the BSR reporting, if it becomes applicable to more companies, you will see that data is equivalent or larger than the actual annual financial statement. So whether the companies, smaller companies right now have the bandwidth to do it, that's another question. So that is why right now it is coming in a phased manner. It is coming slowly. Again next year I think they will increase it to 5,000 companies. That is the discussion which is happening. So it will get to like maybe 5,000 companies. And plus, if I say that I am 5,000, it is mandatory for 5,000 companies. There should be professionals who can handle it.
My question is, why you go by market capitalization instead of you can go by consumption?
Consumption of what?
See the base covering for this reporting. You are telling 1,000 companies going by market capitalization, right? Why is the market capitalization kept as a
Parameter for
parameter
benchmark.
instead of energy consumption or water consumption? Why is that correct, sir? What is it?
So one thing is that if you only go by input consumption, maybe you will leave aside the service sector or something, then only the manufacturing companies will be majorly because their procurement or consumption of items is more. And initially SEBI wanted to just target the top 1,000 company by market capitalization, but because by definition they are the company with the technical bandwidth to do it. So right now it's still in early stage. Later on maybe they will come up with more parameters for it.
No, I think it is like SEBI, because it is SEBI who is, imposing it.
Parameter should be the consumption. Parameter should be the consumption.
No, if
But
it is
Consumption, but first year you don't have the data also. There was no data. So how will they get the data also for consumptions? Like the metric ton, gallons, whatever you say, they don't have the data also. So this 2-3 years the data will come. Then maybe later on they can come into the input part also. But right now you don't have the exact data also. No? There was no reporting for, suppose you wanted to use how much pollution you were emitting. There was no specific data for that. So how can that be? That is a very subjective database right now.
also, I guess, which board is implementing it? Like, who is
SEBI could have won with
implementing it?
turnover also, but they chose market capitalization, and this is purely on a reservation basis that they thought that by market capitalization I can actually capture the higher companies, the bigger companies. So that is the main reasons. So even if you are not in, so for example, I tell you, the top 1000 company right now, they are preferring the big 4 or the other 4-5 consultancy firm for the BSR reporting. But there is a lot of scope of work for actually preparing the report also. But because these entities are not preparing the report by themselves. It's like the financials, technically the management is supposed to draw up the financials. Similarly, the management is supposed to draw up the entire framework of BSR report. The BSR, the person who is ultimately signing off the report, he will check the data. So you can always support in the BSR preparation also. It is not mandated that you have to be the person who is signing off the report. So this is what we happened with us also right now, which we are doing. So we are supporting the companies with 3 years of BSR report preparation. Building BSR ready internal systems. This is an interesting area, and for this you will technically need a good team with engineers and everybody, because companies are coming out and saying we don't have the requisite technical persons to give you all the data which SEBI is requiring regarding consumption, input, emittance, EPR. So we need people who can set up these procedures and structure for us. Now you can implement, you can help in implementation of these, but obviously again as a finance professional it is very difficult. You will then need to get the support of energy auditor and other engineering class. So you need to build a team if you want to add to the third point, which is building BSR ready internal systems. Training board and compliances team. Again, if it is only purely from compliance part, we can easily do it. If we say training, then training can be very vast, because training can be for environmental also, for social also, for governance also. Now can anybody tell me, when I say environmental, everybody can see what is environmental. You can see about how much the company is making the pollutions and all. What about social? What are the parameters of social in BSR reporting? Employment generation is there, but employment is the right word, but then there is a lot of
rural employment. Like
yeah, so how many male and female ratio you are maintaining?
Yeah.
How many people you are taking in from rural areas? Then there was a discussion what is a rural area also. So then they went ahead with the Niti Aayog definition of a rural area. Initially they forgot to mention what is a rural area. So then later on they made an amendment that okay, this rural area definition goes by Niti Aayog. Anybody has any query for the BSR reporting service, because this is the main area of activity. If you are looking to start ESG reporting or work in the ESG field, this area is going to be the key changer for all of us. BSR reporting services.
One question. Given that it is applicable only to the top 1000 by market cap, and many of us might have a lot of MSME client base. So how do we pitch this and how do we convince them to go?
So we'll cover this and the coming slide it is coming for smaller companies also. I'll cover that. Third is ESG advisory services. So far I have covered BSR reporting, but again, like I wanted to tell you from the first thing, BSR and ESG are two different things. BSR is only the SEBI compliance or the SEBI related framework. ESG is the broader concept. Companies may not have BSR reporting mandate, but they still can go for ESG advisory services because, for example, I will give you an example. There are a lot of companies which export items to European Union countries. Now, the countries which are based in EU, they have a rule now that if they are importing something from non-EU nations, they want that ESG parameters to be met. So, if you are selling a product to a country which is based in the European Union, you need to have the parameters checked. So they want a green report. The term loosely it is called a green report. That all the terms are matching and the parameters are so wide and variety. So as a finance professional, obviously you will be able to meet some point, but then again you will need the support of certain engineers or energy auditor. Energy auditors are some people who are recognized in panel with EEE, it's a government agency. So you need the support of energy auditor to give the green report. So, sir, this one point we are covering in ESG also for MSMEs, that if you are an exporter, you will again need the ESG advisory service or ESG sustainable report. If you are an exporter, this is only covering exporter. So what can you do in ESG advisory services? There is materiality assessment. Materiality assessment will also come in BSR reporting. That ultimately materiality assessment is very much similar to what we do in financial parameters also. That will be, what you are reporting will need to be material, and that is again it's a subjective call which the management and the BSR professional has to take. Alignment with global framework GRI TCFD, different from BSR body, not restricted to top 1000 companies. This is what I really wanted to say, that BSR report is very very restricted to 1000 company. ESG is a broader framework. That is why you will always see that people are saying we are ESG advisors, not BSR reporting advisors. Because BSR right now is only 1000 company and BSR is a reporting framework. ESG is the ultimate umbrella, and in ESG also you can choose your areas, whether you want to cover environmental, whether you want to cover social, or whether you want to even go for governance. Governance still there is a lot of vagueness to it, what they mean by governance, because already in Companies Act and all there are a lot of inputs in the Companies Act also. So governance is not an area which is SEBI is looking into much right now, because it is already there in SEBI Act and Companies Act. But ES, which is environmental and social, these two are being really heavily covered in the ESG framework as well as BSR reporting framework. Again, once you implement the ESG controls, there has to be internal audits of ESG, review of ESG governance structure, KPI tracking and controlling testing, ESG related risk mitigation. Now what is happening with this risk mitigation is that if a new investor or third party company is coming into your company, they are checking your ESG matrix from purely a risk mitigation point of view. Whether you are non-compliant, whether the company which is investing, they have a risk of investing in your company. So these type of services are going to become more and more applicable to even MSMEs. Now this is again a very good area which is really coming up. Right now it is really restricted to larger entities, but this will become, I think, more and more significant in the near future, which is green finance. Did you know Ghaziabad was once rated the most dirtiest city in India? Ghaziabad. So Ghazia municipality, they become the first municipality in India to take out a bond for cleanness. I don't recall the name. So they are actually asking public to invest money so that they can clean Ghaziabad. So this is called green fund. They are raising the green bond. Similarly, they have been huge, many banks. SDFC has come out, Yes Bank has come out with green bonds. And right now it is not applicable to public, retail public. Mostly the entities for CSR, they are doing it. So they invest in these green bonds. Similarly, there is green blue bonds also, which is for ocean development. So what will happen is, right now it is with the banks and government agencies which are coming out with green bonds and all. Later on, you will see corporates also coming issuing these type of bonds for raising funds. And this is an area in which for compliance part also and for issuing the entire bond, you can help the companies. But now you will say this will come after many years, what we are going to do now. But if you are not going to have a jump start now, if you are not going to place yourself and say I have the compliance bandwidth to do this, 3 years later nobody will come to you. They will again go to the other Big 4 or Big 10 to do this advisory for green bonds and all. So you need to start taking in the information, the education for these type of advisory, so that next 2-3 years this type of activity will become very common in the corporate world also. So this is a point which I have just written: skills and tools, knowledge of ESG regulations and frameworks. Obviously, without the regulations and frameworks, you will not have any idea. But when I talk about ESG regulations, don't only read about SEBI regulations. There are other parts also. You can also read the Karnataka government policy. They are coming out with a lot of things for ESG. So it is just not SEBI. Don't restrict yourself to SEBI. And if you are interested in learning about the global practices, you can also read about GRI, which is the Global Reporting Framework. Ultimately, all the Indian standards, we are taking it from GRI only. Use of ESG platform and carbon accounting tools. Can anybody tell me, have they checked with any company, have they seen the carbon accounting tools? Or do anybody have any idea about what is carbon credit ratings, carbon credit input, anything? Have you heard about anything? EPR?
I have carbon credits, but I don't know how it works.
Okay. Anything about EPR?
10 years back itself we heard about carbon credits.
Yeah.
How it was in there.
And anything on EPR? EPR is a very common thing, and I think if somebody is thinking that what is ESG going to do, EPR is even applicable to MSMEs, smaller entities. Anybody have done EPR work, EPR registration, anything? So EPR is extended producer license. What happens is there are a lot of compliance that if you are producing some goods and that good is being sold in entire India, you are creating e-waste from that good. For example, if you are selling mobiles, the government wants you to compensate for the environmental issues which you are creating through this e-waste. How will you, when you are selling in the entire India, how will you mitigate the risk environmental issues for entire India when you are sitting in Delhi or Bangalore? So this is a registration called EPR. What happens is, you will buy the credits, you will take a registration of EPR credits, you will buy that much. So the person who is actually, for example, some people is selling some items in Bangalore and then in Delhi. I am a recycler in Bangalore. I am doing recycling. So I have plus points of EPR. I will register with EPR for plus points, and the company which is selling the item, they will also register with their EPR, and they will buy my credits. So they are technically not doing the entire India-wise recycling, but they are buying the credit, they are paying off the recyclers like me. So this is called EPR, and this is mandatory for everybody. You may have companies which are doing recycling work some sort of, and we people don't know that they can register themselves with EPR and they can earn good amount of money. So EPR registration is already there. We can do it for every small entities also which you have if you are in the recycling business. So you can, this is already there, so I think we should be able to know what is EPR.
Okay, it's just a reimbursement to the recycling person by the person who is producing that, selling
No, it's
that.
not a reimbursement, it's an extra profit. See, if I am recycling,
Okay,
what I am doing with the recycled product, I am selling it to somebody.
yes.
That is
You
fine.
get a credit.
But then I will report it to the government portal of EPR that this month I have recycled this unit of items,
Yes.
plastic items or something. So I will get credit points against those things. So even I have sold the items, that is my normal sale purchase. Government is giving me extra credits.
The other person who is selling the, who buys the credits, so this person will be getting,
The recycler is getting the money
okay, that's what.
against his credits.
Yeah.
Now the person who actually sold the mobile, who has produced the mobile, he doesn't need to create his own recycling firms all over India. He's paying me off. So his obligation is also met. I am also getting an incentive to do recycling business.
Carbon accounting is something.
See, carbon accounting, EPR is one part of it. There can be other things also. So if you have a credit, how will you account it for? What is the monetary value to it? So there are tools to recognize it. How do you recognize the carbon? Actually, I am also not in the accounting domain, that is not my area.
Okay.
But I tell you this, that you have inputs. How do you account it for? It's an asset for you. Okay, so how do you account it for? There are a lot of tools. Then you will have to measure how many units you have recycled. So there are a lot of things which is, that is company specific to industry wise you will see. So for example, we just got EPR license for one of our clients. So they are not doing anything sustainable technically. They are also plastic recyclers also, and they get good amount of money from recycling. But then we added that, we got an EPR certificate, so now they are selling the EPR credits also. And people will buy it. They have the manufacturers have obligations to do it. Opportunities for CA firms, establish ESG focused verticals. Obviously, this is going to be a very niche area. You cannot say that as a one person I am also doing ITR filing and I will also do your ESG filing. You need to have certain, because this area it takes a lot of efforts purely from an education point of view. Collaborate with consultants and legal experts. Consultants, like I told you, you cannot do it alone. You need to have team of energy. You don't need to actually have them in the payroll. There are a lot of energy auditors and engineers out there. You can collaborate with them. Other ESG training and audit tools, for example, this is coming up big. Even I think RBI is also building over it that, for example, if you are an MSME and you are going for some sort of working capital loan, you generally get a CRISIL rating, right? You get a credit. there's a talk going on that RBI will make it mandatory for certain MSMEs, I think above 50 CR or something, they're going for loan. They will have to get a ESG rating also then. It's already white paper has been issued by RBI for it. So this will come. So till this point, anybody has any other query? So now we move into a very interesting point. How many people know about social stock exchange? SSE. Any idea? This came in 2022. So the finance minister in budget of I think 2022, she came out with this term social stock exchange, and then SEBI implemented it. So you will see that NSE and both NSE BSE have a platform called social stock exchange. Like they have a platform for commodity marketing, equity marketing, they have a platform for social stock exchange also. Now again, this is a very good area, still it is not picked up. I don't know how will they manage it also. To be honest, SSE has failed in all the countries in which they have started. It failed in US, it failed in I think other 4 or 5 countries also. It is working in Brazil. Brazil is one of the green shoots, what we call that. It is one of the countries in which social stock exchange is actually working. What do you mean by a social stock exchange? It means NGOs can list themselves with NSE and BSE through the SSE portal and then ask for funding. So any NPO, non-profit organizations can also now register and list themselves with SSE. In 2022, SEBI came out, SEBI amended ICDR policies and added this SSE portal. Any NGO having a corpus fund donation for 50 lakhs in a year or a spending of more than 50 lakhs in a year, it is mandated for them to register themselves with social stock exchange. So they may not go for listing, but they still have to register. Why? Government wanted to bring in transparency in the NGO working. Lot of NGOs are in the money laundering area and also government want to curb that black money intake and outflow. That is why they want to make sure that these NGOs are now under the domain of SEBI, the transparency which a listed company is supposed to manage, this NPOs are also going to manage. This has already been passed. This is the act. What happened was, after 2022 and 2024, the election was in full mode. So government thought where the funds will come and all. So they actually did not pass this. They have not stringently applied this. Technically, it is a law. Any NPO, Section 8 company, NGO, they are required to register themselves with social stock exchange. Now, there is a difference between exchange registration and listing. When you register yourself, it means you are only registering for the compliance part. Now, if you say I want to raise funds also, then you go for listing like an IPO. So, did you know that Bangalore is the first city in India which had got its NPO listed? We don't know this. The NPO called Unnati. It got listed last year. This is the first NPO in India which got listed, not registered, listed. So, there was, till last year, I think 50-60 NPOs that got registered. The first to get listed was our own Bangalore Unnati. So, they got listed. So, the company secretary, the compliance officer, are a very good friend of us, so I know the entire process around. So, that is Unnati became the first NPO. Now, I think 15-20 NPOs have already listed themselves in the social stock exchange. So what? Now you will say, who will invest in these NGOs? Why will I invest in NGOs? You are not going to invest. The corporates are going to invest in NGOs. So what will happen is, corporates have a CSR obligation. Government wants them not to don't invest in NGOs or non-recognized NPOs. Government wants them to invest in NGOs which are listed with the social stock exchange because the transparency will be 100%. So there is a concept called ZCZP. Anybody knowing the full form? Any answer?
Zero coupon, zero principal.
Correct, sir. So the bonds which they issue after listing are called ZCZP. Means zero coupon, zero principal. I will not give you coupons also, interest. I will not give you principal also. That money is entirely mine, the NGO. So they are also investing as a donation. But the framework has been created in such a manner that it looks like they are investing in some IPO because you became a stakeholder of that company for a certain period of time because you have to mention in the ZCZP what is the tenure of the entire bond. and that bond has to be done in a very for a specific item. Like if you cannot say I can do anything with that. So in the like a DRSP we file, right, for IPOs. Similarly, you are filing DRSP with SEBI, that what will you do with the money which you get for the bonds. So you have to be very specific. Like if you say I am going for rural education or some social activity you are doing, so that has to be mentioned. So what happens, the company CSR also, they are going to spend that money, so they also know what I am spending the money for, what I am investing or donating the money for. So this is a new concept. It came out in 2022. It has yet to really take its swing, but we are hopeful. So like I said, the SEBI made amendments to the ICDR and LODR policy in 2022, August 2022 you can see the ICDR amendments. Earlier, it was said, and then came the concept of social auditors. So SEBI wanted that these NPOs will be audited by not by chartered accountants. Chartered accountants are doing the financial audit. SEBI wanted to see the social part of it. So for that, the concept of social auditor came into India in 2022. The first exam was conducted by NISM in 2023. Do you know our institute have a subsidiary called ISAI in Mumbai, Institute of Social Auditors of India. It's a 100% subsidiary of ICAI. And the people who pass the exam for social audit, they can register themselves with ISAI. So I was in the top 15-20 people. The exam started in March. I passed in March only. So that time it was called social audit. Later on, SEBI came out and said the audit word doesn't look good. We'll change it. So now it has been re-christened to SIA, which is called Social Impact Assessors. Key professional contributions, cost analysis for social program, fund employment, these are all part of social impact assessment only. Internal financial controls, regulatory compliance, oversight, support in impact reporting and social audits. And do you know that our institute has also come out with 16 standards for social audit? These are all there these all came in 22-23. There are 16 social audit standards which are called SAS, issued by ISAI. You can find those in the ISAI website also. You can read I have written on all the social audit standards. All the 16 are there available in the websites. So what are the opportunities for you? You can be a SSC compliance advisor for NPOs and FPSC, fund utilization audits and impact costing expert, consultant for SSC listing documentations, collaborator with ISAI impaneled social auditors. This will be now changed to social impact assessor, and SSC ready MIS and ERP system. So, do you know that the entities which are going to do the audit of these type of listed NGOs or help them in listing and all, they are going to be called SREs, social responsible entities. Right now, how many entities SREs are there in India? Anybody, any idea? So there are only I think 3 or 4 SREs in total. Approval takes a hell lot of time because you need to have at least 3 years of experience in social audit domain to even think about registering yourself as a social register SRE. So right now there are only 3 or 4 entities in India which are registered as SREs. These are all the activities which you can do: cost structuring, financial due diligence, pricing the ZC, ZP, and everything obviously has to be done as per the SEBI guidelines. Then again, preparation of initial disclosure documents, audit of project costing and impact fund, governance advisory. I am not going to cover all this is like only these are more theoretical. Impact reporting, cost benefit analysis, social audit collaboration, budget. Now can anybody tell me what is the difference between our audit, what we do as a CA, and what is going to be a difference between the social impact assessment or social audit? Because there is a clear difference. That is why this new vertical has come. Anybody can tell me? See, as a CA, when you go for an audit of any NGO, what do you see? If you see there is a payment, you will ask for an invoice, right? You will see the invoice is matching with the payment, you are okay, you do the tick and all, and the audit is completed, right? Social impact assessment may you need to see that money was used judicially in a way that what is the impact of that money payment. So, if you are an orphanage or if you are a school, did that money created the necessary impact, whether the money was utilized judiciously? So that is why it is different from the normal audit which we do. Now, initially in 2022, when SEBI came out with all the social impact rules and all, social audit, only CAs were allowed. So Institute opened its ISAI vertical. Later on, there was a lot of documentations and lot of flows from CS and other institutes also. So now there are 3 institutes which are doing it for social audit also. So all the 3 institutes can do members can become social impact assessors. So again, this is going to be a very challenging field in that regard. Obviously, that it's a very niche category, it's a developing category. We know that there will be standardization issues, evolving regulations, talent gap is obviously there. And talent gap is a very big word. Why? Because social audit and this ESG implementation is very big in the MENA countries also, Middle East and North African countries. There also they don't have any resource. Lot of our own CS fraternity people are going to Saudi Arabia, Uzbekistan and doing ESG implementation activities for those scientific companies there because they don't have resources there. So talent gap is a huge, it can be a problem also, it can be an opportunity also.
Problem in the sense?
Sorry?
It can be a problem in the sense what would be the
Problem, we don't have resources. Technically you don't have resources to do it. Nobody has any knowledge. So it is there because in India also we don't have much of an education for this.
Okay.
Right, and you need to have a good amount of team, because you will need the support of engineers. That is must. Without that, you will not be able to do any type of ESG reporting, because ESG primarily is not about numbers. So the entire process has to be challenged. The entire process has to be checked. So as a finance professional, it is not your area. You will need the support. Ultimately, you will be the signing off person, but you need a good amount of team. So you need the support of engineers. Energy auditors, you can read about EEE, it's a government agency which gives out energy audit empowerment. So you can read about what is the requirement to become energy auditors and what is EEE. And EEE also, I think they also work with the carbon credit part. So they take out the rules for carbon credit and all in India. So like I told, the global opportunities, they have a remarkable traction in MENA countries for ESG. I'll give you a brief example of my friend. So she got one assignment from Saudi Arabia and she prepared the report, and that was for some women development activity, women and child development. And she gave the report and she got certain comments back. So those comments she implemented in the report, and then again she sent back the report. Now again she got some new comment from some other email ID. Then again she did the implementation, and then again she sent the report. Then again after a few days she got another revert back. So this time she got confused, who actually am I working with? I know one person. So then she called up the person. So he said that actually I have also got this work from outsource. I am also not the primary consultant on this. So then he connected with another agency. That person also told, I am also not the primary consultant. This activity was given to PwC Saudi Arabia. They don't have the resource person. They outsourced it to advisory A, I will not name. Then they outsourced to advisory B. Advisory B also did not have the person, so they ultimately gave it to my friend. And ultimately the work was being done for the Ministry of Women Development in Saudi Arabia. So it was a big ticket work. So even the big fours and other advisory don't have much resource in these type of countries. There's a lot of, you will see that there are a couple of entities in India which have registered themselves in Uzbekistan and Saudi Arabia, and they are doing a lot of good work in ESG circle. Now we come to the main part, what are the qualifications of social impact or ESG reporting. The first thing is the social impact assessment exam by SEBI, which is conducted by NISM. This is the main, if you want to get involved with the social impact part, which is mostly for NGOs, then this is the right qualification for you. Because after you pass this examinations, you will get the credentials of a SIA, Social Impact Assessor, which is a 3 years validity. And then you can do all these activities of social impact assessment. Social audit is mandatory for all NPOs which are listed or registered with Social Stock Exchange. But the implementation has been very slow, very slow. And secondly, the main, if we see about the revenue part, if you are dealing with NGOs, you will have to adjust for the fact that these are NGOs, so the billing and the fees part may not be up to your liking. So this is like your CSR activity. Second is the certificate course on ESG, BSR by ICI. Institute also conducts certificate courses for BSR reporting and all. You get a brief, fair idea about what is required for the framework, BSR core, BSR the reporting framework. So that's a good certificate course for if you want to have a primary idea about BSR reporting. Then you can go for GRI reporting certifications. They are done by Big Fours also, and Bangalore has a GRI is a global reporting board type of act. So they have different offices. They have one in Bangalore also, but their certification happens very infrequently. They do tie up with Big Fours and all, and KPMG also, they also do the certifications. So if you want to have a global mandate, you can go for GRI, but I would suggest to first go for the first two and then go for the global practice of GRI and all. I have highlighted this point. Currently, there is no mandate or qualification required for you to do BSR reporting. Right now also you can stand up, go outside and call your district client that I will do BSR reporting, because there is no qualification. Anybody can do it. Whether they will select you, that is their call. So I can, because I want to, we started late, so I want to conclude it faster. So conclusion is that ESG and BSR are strategic opportunities, not just compliance. Don't think about them as compliance part, and don't think right now that it's still years away, what will I do now? If you don't start to project yourself right now, it will, after 2 years, 3 years, you will not get ESG work. There's a lot of good work coming up. You know, NSC has opened its own ESG credit rating, because there's going to be so much amount of work which is coming in credit rating agencies or field also for ESG. If you, I don't know how many of you deal with valuations. There's a body called International Valuation Society which covers the international valuation standards. IVS has amended their international valuation standards and mentioned that in all the reporting ESG, there has to be certain inputs on ESG also. So valuation exercise of a company will also be directly impacted by ESG. So later on, for bigger enterprise who are going for valuation, they will also have to get ESG credit rating done. So ESG credit agency, you can check, SEBI has come out with their own circulars. There are two types of agencies, grade A, grade B. Grade is very high, I think 10 crore or something. That is mostly done by grade A rating agencies are, I think, NSC, ICRA. But you can also cover grade B, because when RBI comes out with the working capital loan framework ratings, those will be mostly done by category B ratings. So rating agencies will also become very, but again, if you don't have the requisite qualification and education right now, you will not be able to open your rating agencies also. So this is it, time to impress, sustainability and everything. And I'll also say one regarding the MSME point, I'll give you just one input. One of my clients is going for an investment, and the company which is coming for the investment, they are from US, and they have asked for a sustainability report, even though it is not mandatory for them to report. So we are supporting them for that, because if you are dealing with, if you have any sort of exposure with foreign companies, either through trade or through investment, ESG rating will in the near future it will become mandatory for them. These are my contact information. Any sort of any query, please feel free to reach out. Any other questions? Only those which I can answer. If I don't know answer question, I won't be able to answer. Any question? If you have any doubts.
Even like IIM and all is giving some 12 months course on ESG and all.
Yeah, I think IIM Kozhikode, I think came out with one. I think I was not really happy with the curriculum. It was very much same which ICI is also giving in the BSR reporting, and the fees is I think 4 times or 5 times. And it is again, it doesn't give you any mandatory qualification. It is again the certificate course only. So purely from a branding exercise, yeah, but I don't know. Any other question? Anything regarding social impact or ESG, anything?
Thank you, Neeraj. I call upon Chairman to please hand over the moment to the speaker. Let's have a round of applause. Thank you. We'll have a break for 10 minutes, quick break. However, we are late, so let's join quickly. Right? Thank you.
Good evening, everybody. At the outset, I would like to thank the Bangalore branch for inviting me to speak on a topic of obviously my choice and my liking. And Chairman Sir was kind enough to give this opportunity for me to learn and then present and have a nice, meaningful discussion with my fellow CAs. Today, the tax laws are evolving, and what more than the new income tax bill that was just introduced in the parliament a couple of days back. So, in India and globally, there is a dramatic change of how the business is conducted, of how tax laws are viewing the business, and what are the tax ramifications. There is UN, there is OECD, there is SARC. All these bodies are trying to make significant progress in shaping the tax laws across jurisdictions. And obviously there is so much happening locally as well as internationally on the tax front that we as tax professionals, especially the ones who are practicing an income tax, need to be abreast of what is happening internationally, which has a direct impact in India. Today, while my endeavor is to cover a lot of aspects which are recent trends in international tax, with the focus of obviously India, there is an increased requirement or compliance reporting for foreign assets and incomes. There are issues like permanent establishment, the recent Supreme Court decision in Haya. You have OECD and BEPS, which are causing a seismic shift in all of the tax policies across the globe. India is adopting and implementing changes faster than the world. There is significant economic presence, which is in BEPS Action 5 plan. There is equalization levy, which was Action Plan 1 of BEPS. There is limitation of benefits of interest, which is the thin capitalization under Section 94B, which is Action Plan 4. CBCR reporting, which is Action Plan 13. There is MLI, which has amended the tax treaties multilaterally through a single instrument, which is a product of Article 15 of the BEPS Action Plan. There is Pillar 1 and Pillar 2, which is replacing Action Plan 1. If you see across, all of these have an impact on the Indian income tax as it stands today. There is royalty and FTS, which has been a perennial issue. There has been some amount of respite after the engineering analysis with regard to royalty, but still you will have a lot of litigation in this aspect. There is foreign tax credit litigation, as simple as Form 67 is not filed within the time. There is tremendous litigation of what exactly is a tax, which is a double tax income, what are the implications of those. There is TRC related issues, whether a tax residency certificate of a country, is it a sufficient document for me to invoke and get the benefits under the tax treaties. So while my endeavor is to cover a lot of things, today we will start with the first topic, which is decoding the foreign assets and income compliance. So we know today the world is becoming global. There is liberalization in terms of foreign investments. Employees, people, everyone has some or the other exposure to other countries in terms of assets, in terms of incomes. So what are the reporting requirements and why is this gaining so much of focus in today? What are the changing landscapes? There is a new transparency era. There is a global push for sharing and receiving tax related information with regard to SECs. There is CRS, which is a common reporting standard, the FATCA law of US, which is the Foreign Account Tax Compliance Act, wherein every account that is being held by a US is being reported. India has tax exchange, information exchange treaties. It has automatic exchange of information with more than 171 countries. the CRS Common Reporting Standard, which allows for sharing of information that is being entered into 123 countries. India has the widest network of tax information available. So what are they doing with that information? They today have set up an FAIU, the Foreign Asset Investigation Unit. It's a separate wing only to trace foreign assets, undisclosed income, have the implications under Black Money Act enforced. So there is so much information available with the tax authorities, and I'm sure in our day-to-day practice we have seen SSCs receiving notices under section 131A, 133(6), 135A, where they are seeking information regarding foreign assets, foreign incomes, which they already have information of, and now they are giving us a chance to probably come clean, file any updated returns, file any revised returns. The taxmen are using AI through automated scrutiny, scoring at CPCs. Then they recently used Nudge, which is a non-intrusive usage of data to guide and enable taxpayers. They nudged the taxpayers that, look, we have information regarding or relating to you, that you have accounts outside India, you have incomes outside India, and you've not been reporting them. So let us know if this is true. If it's not true, then you can have an opportunity to contest. If it's true, then you have a chance to file an updated return or a revised return. So what are the incomes or assets that today the taxmen are looking at? You have ESOPs, you have cryptos, you have properties, immovable. You made overseas direct investments using the FEMA LRS. You have shares in foreign companies, cryptocurrency, foreign bank and depository accounts, immovable property, stock option, pension funds. When you were employed outside India, you have 409k accounts. You have the other pension accounts in US or UK, mutual fund holdings, trusts. So all these informations today, through the wide network agreed between the governments, is now available to the taxpayers. Looking at statistics, in 21-22 assessment year, there are about 60,000 taxpayers who are reporting foreign assets and incomes. That has increased to about 231,000 in a matter of 2-3 years. That's a 4x increase. In fact, just this special campaign run by CBDT in November 2024 resulted in about 29,000 crores worth of undisclosed foreign assets being reported, additional foreign income of 1,000 crores, more than about 24,000 SECs filed a revised return, 5,000 filed a belated return or an updated return. So there is a growing compliance regulatory requirement by the tax authorities. In fact, the CBDT mentioned that they have got information that more than about 1,000 Indians own houses in Europe. There are tips received from Dubai regarding offshore investments by Indians, and all of these are being investigated, and the notices have already started to trickle in. So what are the reporting requirements? If suppose a person has a foreign asset, so the reporting requirements are only restricted to residents. If you are an RNOR, which is a resident but not ordinary resident under section 6.6, or if you are non-resident, you are exempt from reporting. So what is to be reported? Any foreign assets and income, irrespective of the amount. So you might have $1 or $1 million, it doesn't matter. You have to report. There are requirements. So today the return is made in a way that you have to report assets as on December 31st, 2024. A question might be saying our assessment here is 2025 till March 2025. Why are we required to report under 2024? So this was a big debate where the earlier forms used to require us to report over March 2025, including income and assets. And because the foreign jurisdiction, most of them work in a calendar year, or the tax year is basis a calendar year, there was always a mismatch between assets reported. So they aligned the reporting requirement to make it to calendar year. And that's why if you closely look at Schedule AL and Schedule FA basically of the idea, you will find that these are now restricted to December 2024. So what is to be required? So Schedule FA has more than about 10 sub-tables, which requires us to report foreign depository accounts, custodian accounts, equity and debt instruments, immovable properties, cash value of insurance contract in annuity contracts, financial interest in an entity, other capital assets, accounts in which you are a signatory, trusts created under under the laws outside India, or any other income. And there are rules, Rule 114F to 14H, which govern what each of these means. What is a custodian account? What is a depository account? When do you have to report? What is the manner of reporting? There are obviously instructions to the IPR. So there is a need. There are certain questions that we might have to answer to get to know whether what is to be reported, when is to be reported. For example, if a stateless person under section 61A is deemed to be a resident of India, so for the ease of reference, 61A refers to any person who is a citizen of India but is not a resident of any country in the world by reason of his domicile, residence, or any other criteria of similar nature. So for example, someone who is not a resident of India and makes sure that he is not resident anywhere to escape the global taxation of the global income, then those are deemed to be resident in India as per section 61A. So the question is whether 61A, a person who is a resident as per 61A, is he required to report foreign assets? The answer to that possibly would be that no, because he under section 66 is treated as a resident but not ordinary resident. And since an RNOR is exempt from foreign assets reporting, one can argue that even a resident or deemed resident under 61A would be exempt from foreign reporting. There might be another case where an employee or a citizen of US comes to India for working in one of the Indian companies and happens to earn salary on secondment, which is taxed in India because of the residency in India. So then the question is, because he's a resident, is he also required to report his foreign assets? So then the ITR itself has a clarification to say, if you are a resident but a foreign citizen, you're not required to report all those foreign assets which you acquired when you were a non-resident and your income was outside India and you've not earned any income in that year from that. So if you've not earned an income, so the conditions are if you're a foreign citizen, you have acquired these assets when you were a non-resident, you don't have any income in India, then you need not report those assets. I am not going to go into much detail of what is to be reported, how is to be reported. I think there is enough material under the rules as well as under the instructions. What happens if I don't report? What is the penalties for non-disclosure? Under the Income Tax Act, obviously non-disclosure of income, whatever be the penalties under section 270A(9) for misreporting or for underreporting, those would apply. But besides that, foreign assets have a peculiar liking. There is the Black Money Act that gets invoked. So Black Money Act of 2015 was introduced to tax or penalize any undisclosed foreign assets and incomes. So what happens if there is some assets or income that is undisclosed? There are three penalty provisions under the Black Money Act: Section 41, Section 42, and Section 43. Section 41 deals with the amount of income or assets that has been undisclosed. So you have to pay 3x of the penalty. So 300% of the penalty of the tax on the undisclosed income or asset. That is basis the undisclosed assets or income identified by the assessing officer. However, the non-reporting of assets in Schedule FA invokes Section 42 and 43. 42 is invoked where an assessee has not filed a return of income under Section 139(1) before the end of the assessment year, but has foreign assets. And then the assessing officer comes to know that there is foreign assets. There will be a penalty under Section 42 of the Black Money Act, and the maximum penalty or the penalty leviable is 10 lakh rupees. There is Section 43 which covers that assuming you have filed your return of income, but still you have not reported certain foreign assets or income, or you have reported wrong foreign assets, incorrect particulars of foreign assets or income, then you will still be liable to pay a penalty of rupees 10 lakhs. There was only one exception to this, to say if you held bank accounts outside India whose balance was less than 5 lakh rupees, then the assessing officer would not have levied penalty. However, in October 2024, they brought a very well required or a very important amendment to say if you hold any movable assets up to a value of 20 lakh rupees and you have missed reporting those assets, then in that case the penalty will not be levied and you get an exemption. So there's a blanket exemption of up to about 20 lakh rupees. However, this is only for movable assets. If you hold an immovable asset, you are required to report and the penalty would be levied. So besides penalty, what else can apply? So there is prosecution, and that's the biggest threat besides the penalty. Penalties are monetary, people are ready to pay penalties. But prosecution risk is one that deters non-compliance. And prosecution is for a period which may not be less than 6 months but up to 7 years. And this under section 49 or 50 of the Black Money Act is the biggest deterrence for SECs who are non-compliant. Right now there is so much emphasis put on foreign assets and income by the department, by the legislator, that if there is any detection by the department, they are proceeding to levy penalty. They are also proceeding to initiate prosecution. There are decisions now in the domain to say whether an SEC who doesn't have undisclosed source of foreign assets. He has all disclosed source, but he's just inadvertently missed to report them in Schedule FA. Is he also liable to pay penalty? Unfortunately, there are decisions against the SEC in Harish Savani versus CIT in Mumbai Tribunal. There are a couple of 4 decisions where they have looked at the circumstances beyond the non-reporting to say, okay, have you offered the income? Was it from your legitimate sources? What was the reason why you missed out reporting? And looking at that, there have been certain favorable decisions, but that is an exception, and we must be wary that if there is a non-reporting, there can be penalties and initiation under prosecution under Black Money Act. What are the statistics? Some statistics of proceedings under Black Money Act. It is just about 10 years now that the Act is introduced. There has been more than about 1,000 assessments that are complete, and this is as recent as a parliament reply given by the Minister of State of Finance. And there is about 35,000 crores worth of tax or penalty demand raised. So that means the assessment has resulted in significant amount. Though the collection amount is meager of 300 crores, but there is so much in pipeline, and this is just the start. Because the exchange of information has become more active in the last couple of years, and now the department is in a much better position to have information regarding your assets and income more than in fact what you also have. Yes.
What if I have not declared the foreign asset foreign assets, not income assets? Now last year, but I declared in this year.
Okay.
Point number 2. What is the limit for prosecution? Is that depends on the extent of evasion or
So the first question, if I have not reported in last year and I have reported this year, unfortunately the assessment will be qua each year, and the way the Black Money Act is introduced, irrespective of whenever you have invested in the asset, the day in which it comes to the notice of the assessing officer, it is deemed to be invested in that year. So they can initiate penalty provisions in the year in which they come to know about the asset. The fact that you have not reported in 1 year and reported voluntarily in the second year can just be a ground for you to probably escape from penalty, but that is going to be at the mercy of the assessing officer, or you might have to litigate it further. Coming to your second question of how the prosecution would start. Today, as you can see from the statistics, while there have been over 1,000 cases where the assessments have been completed, 163 have resulted in prosecution. The prosecution obviously is something that they will want to look at where there is an undisclosed foreign asset. When we say undisclosed, the definition of undisclosed foreign asset includes that assets where you are not able to justify the source of that asset. In most of the cases where the assessments or the penalties are levied, is just an inadvertent reporting mistake, which is under section 49 or 50. So if you just missed reporting, that is a far lesser offence rather than having an undisclosed source for a foreign asset. So prosecution, obviously, while the Act does not say so, but what our experience and what we have seen is where the department has a case that you have undisclosed sources of income or undisclosed incomes that you have not reported, then yes, prosecution is initiated.
It depends on the extent of evasion normally.
There is no threshold, unlike even
But normally.
normally it is the fact is that these cases get flagged off only when there is a significant amount involved, and there is a threshold limit of 20 lakhs any which ways now that is built into the act for penalty. So obviously when penalty is also not leviable, the question would be prosecution cannot be levied to up to 20 lakh rupees. So we've seen what are foreign assets, what is the reporting requirement, what are the consequences. Now coming to a scenario where it's pretty common, and today in our day-to-day practice, while we might not look at it actively, but we can from now see and seek information from the employees, because the employees are also not really aware of a lot of issues. So any company that has foreign ESOPs, when I say foreign ESOPs, a subsidiary, for example, I'm just going to take a simple example of Facebook or in fact even Amazon. So the employees of Amazon get ESOP of Amazon Inc., which is a US listed company. So when any employee who's working at Amazon gets ESOPs or RSUs or any other stock option plans which are of a foreign company, then obviously that satisfies the definition of a foreign asset. And these employees knowingly or unknowingly hold foreign assets which are required to be reported. So the question is, what are foreign ESOPs? As I said, these are typically the cross-border ESOPs, where you may also have a situation where an employee of Infosys who is now working in a branch outside India gets shares of or ESOPs of Infosys, which is listed in India. So there can also be a cross-border requirement of a non-resident holding an Indian company shares or an Indian holding a foreign company shares. We will take a few examples in the scenarios that I have outlined, where we will try to cover, see what are the requirements in each of these scenarios. So the question is, what are ESOPs? Why do they? I'm sure everyone is aware why ESOPs are being given. Obviously to retain talent. And the ESOPs are given when the company is nascent or small, and there is liquidity issues. So an employee who deserves a 40 lakh package, but the company might not have 40 lakhs to give him. So they give a 25 lakh package and they give, say, I'll compensate you by way of ESOPs. So that helps the company in liquidity. There is obviously a sense of ownership because there is a sense of long-term involvement of the employee. There is vesting period which is spread over 4 years, so it helps retain the talent. So these are few business reasons why there is ESOPs given. Now, there are obviously various types of ESOPs. There can be options, there can be a proper share purchase wherein the employees are allowed to buy a share directly at a discounted price. There is options where they get an option to buy, and that option is at their discretion. They might exercise, they might not exercise. There is RSUs where typically it's similar to ESOPs, but the fact that it gets vested immediately and it is given free of cost usually. There is also SARs, which is basically they don't get the shares, they only get the incremental value of what a share when they are vested or when they are given vis-a-vis whenever they liquidate. So just briefly touching about what is the taxability of ESOPs before we dwell into a little more details of or issues that we can see on a day-to-day basis. So there are predominantly three important events: a grant, a vesting, and exercise. So what does a grant mean? A grant means that the company issues the options to the employees, issues options, stars or stock, whatever. This is with a condition that you need to satisfy whatever the vesting conditions are, like employment over 4 years, employment over 1 year, or certain performance related conditions. And these grants will then vest with the employee. Second is, these are basically futuristic. There is no tax under the income tax on the event of vesting or on the event of grant. Second is vesting. Vesting is where the grant becomes a right. So the employee has a right to either ask for the shares or get the shares. So that is vesting, and under the Income Tax Act still does not trigger any tax incidence. The third is exercise. Exercise is where this right is now converted into a share, and the employee exercises his option, which is received on vesting, to now convert his option into a share. Section 17 3.26 covers perquisite taxation on ESOPs. So Rule 3, Sub-Rule 8 covers what is the value that is to be taxed and when it is to be taxed. Rule 3.8 says that the value of the perquisite will be as on the date of exercising the option. So whenever the employee exercises the option, the value of the share minus whatever exercise price that he pays is the value of perquisite which would be regarded as salaries and taxable under section 17. So there are certain benefits or exemptions given to startups under section 192 1C where you can defer the payment of tax to 14 days from either 4 years, end of 4 years from the day in which options are exercised, or the employee leaves, or the shares are sold. So within 14 days therefrom you will have to recover and deduct the taxes. That's a benefit only given to 80 IAC eligible startups. Having we looked at what are the tax incidents.
I have a basic question.
Yeah.
As SSC, voting company is in Germany.
Okay.
Okay. They have issued shares.
Yes.
ESOP.
Yes.
So what is that? At the time of issuing, it is covered in CTC.
Yes.
Now that shares are traded in Germany. Somebody sitting in Germany, he sold those shares, they got capital gains.
Right.
So what they are doing with the capital gains tax is deducted and paid there.
Yes, I'll cover that. Probably this slide exactly covers how typically a foreign ESOP work, wherein, say suppose an employee A has got 100 ESOP options to buy shares of a foreign company which is traded for, like servers example, Germany. So assuming these ESOPs have vested and been exercised, so what happens? So the foreign company would deduct or sell those 30% of those shares to recover the perquisite tax, because as on the date of exercise there is a perquisite tax, as we discussed in the previous slide, that whatever be the value of the fair market value minus the exercise price would be taxed as perquisite. To recover the tax on that, the foreign companies typically what they do is they sell 30% of the shares immediately on exercise, so there is no capital gains. However, there is perquisite tax and they recover that money to pay the tax to the Indian government. Thereafter, what happens is the balance 70% gets credited to a depository account which manages their ESOPs, and that now has to be reported. So there are two transactions happening in the year of exercise. One, they get to exercise 100 shares, however 70 gets credited to their ultimate demat account because 30 have been sold on their behalf to recover that perquisite taxation, because what happens is in most of the cases their salary might not be enough to even recover the tax for that month. So what typically happens, and this is the usual case with all the big listed overseas companies, where they would recover this by selling a portion of the ESOP that have been exercised. So like sir, just taking forward your example, when these ESOPs were exercised, there would have been a perquisite taxation that the employer would have to deduct. To recover that tax amount.
It comes as a CTC.
Correct sir. It is forming part of CTC, but the taxability is only on exercise. So even if there is a CTC and if there is a vested option but you have not exercised, there cannot be any TDS deducted. So the trigger event is only on exercise. So assuming there is exercise happening and they have to now pay the TDS to the government, if they have salary they usually pay, if not they recover it by selling a portion of the shares, which in usual cases is about 30%. So this, what it requires is the SSC to report in its ITR in that year that he has received 100 shares, sold 30 and has retained 70 in Schedule FA. So this is where typically most of the SSCs fail to report, because what happens in the foreign land is not really aware to them, and then
No,
they
not
are
even proper details.
exactly.
Most of the cases we don't get proper details.
The only way of identification is if you look at the pay slip on month-to-month basis and you find any perquisite or perquisite, and if you drill down into the details, you can figure out that there is some amount of ESOP that are vested and exercised, and therefore there is some tax deducted, and then what are the consequences of reporting. There is obviously a data available, it's just that they have to get it through the right channel.
It's similar that sale happened in Germany.
Yes.
Is it taxable in Germany?
It is taxable under both, because if it's an Indian resident, my global income is taxable, and whatever tax I have paid in or would have been deducted in Germany is allowed as a credit under foreign tax credit. You will have to file Form 67, make a claim. So that entire leg of it is very important for us to educate the SECs that if there is salary and if you are getting ESOPs, then, and if there are foreign ESOPs, then these are the compliances that we might have to do. So every time there's an event which is on either on exercise or on sale and there is some amount which they receive in the bank account, but that might be just net amount. What exactly we have to see is the gross amount, what are the tax incidents in the foreign country, what is the benefit under DTAA that we can take. So all of those will have to be evaluated case to case basis. I'm just taking 3 scenarios. The first one is a plain simple case where there is an ESOP from a parent company to an Indian subsidiary employee. So typically your FANGs, which is your Facebook, Amazon, Apple, or you look at any startup today which is US based who has a subsidiary in India, you always get the shares of the foreign company. It might be Flipkart, it might be any other the big startups, Lenskart. So what happens? So what are the key considerations? As a company or as a subsidiary company, the Indian company, it can claim the discount given on ESOP as a deduction under Section 37, and there is obviously a special bench decision of Biocon which has been affirmed by the High Court. So you can claim that as a deduction under 37 over the period of vesting. There is the employer has to deduct tax under perquisite under Section 192.
That will be CTC, no sir. Discount will be CTC.
No, the discount would be as on the date on which the employee exercises the ESOPs. The fair market value minus this, which is basically the perquisite tax, is what is the discount given to the employee.
Correct, but the accounting head should be under salary only, no?
And accounting head would be under salaries. Under salaries there will be ESOP
It's
cost.
not discount, it's salary.
It is salary only.
It is CTC.
It is CTC, but the law requires us to apportion that over the period of vesting. So if my vesting is over 4 years, I have to claim this 1/4, 1/4, 1/4, 1/4 every year. So that is from a company point of view. Obviously there are certain FEMA regulatory requirements that they have to file half-yearly report. What is required for an employee? An employee is to report or disclose the foreign assets now that he holds in Schedule FA of ITR 2 or 3. He is liable to pay capital gains tax on the transfer of foreign ESOPs. Though there is no limit under LRS for foreign ESOPs and he can hold more than $250,000, but the amount that he is paying, which is basically the exercise price, will be counted toward his LRS limit of $250,000 USD. What are the key considerations in this simple case? I mean, from an employer point of view, there is TPO in other angles because it's a share of a foreign company. So the foreign company is issuing shares on behalf of the subsidiary. So subsidiary has to make good whatever the cost of that share is. So typically the subsidiary will cross-charge, or the foreign company will cross-charge the subsidiary, and the subsidiary will pay that much amount, that which is subject matter of TP. There have been decisions to say, can a holding company give shares to an employee with subsidiary? There is no employer-employee relationship between the holding company and the employer subsidiary. So is there a requirement for them to deduct perquisite tax? Is this salary at all? Is the larger question that was raised before various tribunals. So one of which was a special bench before Sumit Bhattacharya in 112 ITD 1. The tribunal held that the employer-employee relationship between the holding company and the employee of subsidiary is not required, as long as the employee has got these shares or ESOPs by virtue of his service. That is sufficient for it to be treated as salaries. There is also a similar decision which says that the holding company is getting indirect benefit by the work done by that employee to its subsidiary, because the holding company indirectly or directly holds in the subsidiary and the employees of subsidiary are indirectly working for the holding company. It was held that this would be treated as salaries. So in all our cases, and this is what is the universal practice that is going on, it will be treated as perquisite at the time of exercise. We'll take another scenario. It's a slightly different scenario. It is an employee of Indian subsidiary who is being seconded to his foreign company, which is the holding company outside India, and now he receives the shares. So there are few assumptions obviously that we have to make. Because he is working in a foreign company on deputation, he is treated to be a non-resident or resident but not ordinary resident. So in that case, because these shares have been received when he was a non-resident or a not ordinary resident, there is no reporting requirement under foreign assets because he is not a resident in that year. The larger question is looking at the treaty and the country in which this is. There is also a case for him to say this is not taxable in India because he is rendering the services outside India, and if he satisfies Article 15 of the DTAA, which typically covers dependent personal services, and if he satisfies all the conditions, there is an argument that this cannot be taxed in India. However, on sale, if he is an employee, he is a resident by the time he sells, then there might be tax implications. But if he sells when he is a non-resident, there will not be any tax implications in India on them. I'll take another scenario which is very similar to this, and then I'll cover a few edge cases which are in relation to this. So this case, there is an employee. The ESOP is of an Indian company. The employee is working outside India on some project works, and he receives ESOPs when he is outside India. So the question is, what are the considerations? Obviously, from an employer, it's similar thing because it can claim the discount on the ESOP listed as a deduction. It has to deduct perquisite tax because it's an Indian resident company who's paying the employee. Now, depending on the employee's tax residence, his requirements, his reporting requirement, obviously there's a larger question of whether it would be regarded as a PE of the Indian company who's outside India. That's another thing. But the question that I want to drive here is, assuming there is a situation where an employee who is working in India is granted options, he now moves after some time outside India and then he exercises those options. So at the time of exercise, he is outside India. So can there be a question whether he is liable to tax in India or is liable to tax outside India? There is an OECD commentary on this where it says that if the stock option is exercised in multiple countries, basically the grant happens in one country, the exercise happens in one country, then the portion of the benefit that is derived from each country during his stay. For example, if he stayed in India for 1 year of the vesting period and then he moved to US for 1 year, then the OECD says the portion that he was in India has to be taxed in India, the portion that he was in US has to be taxed in US. So the OECD says that the period of vesting is very important and what are the services rendered during that. There are various tribunal decisions or high court decisions in this matter. The one important decision or ruling in this case is Delhi Tribunal in the case of Robert Arthur Kells versus ACIT. Here, the tribunal held that the residency during the vesting period, if he is a non-resident or RNOR, then that portion cannot be taxed in India. There are contrary views also by the Mumbai Tribunal. There is a very interesting case and I would want to take this. This is a case of Unikrishnan BS in the Mumbai Tribunal. The SSC was an employee of HDFC Bank. He got options granted in June 2007. Thereafter, he was relocated or moved to an Abu Dhabi branch. Now, during his Abu Dhabi branch, he exercised those options and he sold them in 2014. So both exercise and sale happened when he was a resident of Abu Dhabi, UAE. But the options were granted when he exercised the employment when he was in India. So the SEC question or the contention of the SEC was, since the services were rendered outside India, there is no income accruing or arising under Section 5 and therefore this amount of perquisite cannot be taxed in India. A fair argument considering India, UAE does not have any tax on salaries or any personal income. The tribunal, however, viewed that it is not just the exercise or the sale that I have to see. I have to see where did you render the services, where did you exercise the employment, and when did you get the rights. The tribunal in fact went to the fact that when these options were granted, you are an Indian resident and therefore you are liable to pay tax in India. I know this is something which
It looks to be logical.
doesn't look to be logical, but unfortunately, the tribunal's ruling or the understanding was Section 17(2)(6) is only deciding the timing of taxation. To say, I will tax you on the day you exercise. Till you don't exercise, I will not tax you. However, the income is accruing during the vesting period, which is very logical, because as long as you're giving the services, and because your employment was actually exercised in India, just because you were outside India for work while legally being employed by the Indian company or Indian resident, the taxation cannot shift. So this was.
I don't know. If Abu Dhabi got income tax, definitely they will tax the transaction.
Correct, sir.
So now Indian government.
So you will be entitled to claim the foreign tax credit if there is anything. Unfortunately, in this case, there was no foreign tax credit. He wanted to claim an exemption under India to say that there is no source.
Abu Dhabi income tax is not there.
No.
So then in that case, it is not just for Indian government.
No, the Indian government or the
case appeals, no.
it is gone in appeal, and that's what the tribunal finding was. So they linked it back to the date of granting of options, and since at that time you were a resident in India.
Oh, sir, yeah. In case Abu Dhabi income tax is there, they would have direct tax which is there. Just because Abu Dhabi doesn't have income tax doesn't mean that your tax is not there.
No, it's not a question of, it's not going under DDAA, it is under Section 5, whether there is a scope. He's a non-resident and that's undeniable. So the question is, when it's a non-resident and it's an Indian company whose ESOPs were given or shares were given, the question is salary, whether it is accruing in India or outside India.
But you was a non-resident, right? You was a
Yes,
non-resident.
yes.
Whatever case it is, you was a non-resident. He exercised the option when he was in Abu Dhabi.
Correct, but he
So
got
the
grant.
taxation point should be at the point of.
Exactly. Looking at that, that is what the SSC argued, saying at the time of exercise, since I was a non-resident,
Sorry, which case, sir?
it is Uni Krishnan VS versus ITO, Mumbai Tribunal, ITA number 1200 and 1201 of 2018. It's a recent tribunal decision. So I'm completely aligned. The OECD or the other tribunal decisions are saying that you will have to look at the period where you rendered service here and rendered there and allocate the incomes accordingly. That's a more logical way, but unfortunately this is not
It's
the
supposed because Abu Dhabi is not tax. In Abu Dhabi they don't tax. Just because there is no credit, it is up. Otherwise, there is.
Anyways, there's no tax, it's not doubly taxed income. So from the SSC's point of view, there's not double taxation. The only taxation was India. Whether India is right to tax is the question that was.
It is as good as double tax. Just because Abu Dhabi is not taxed, that doesn't mean that he declares in Abu Dhabi.
Correct.
Because there is no income tax in Abu Dhabi, this will, no, that notion I think. Because otherwise you would have filed in whatever situation.
Right. So there are.
One question.
Yeah,
Now,
please.
in this question, if they are to be reversed, like suppose if they have been worked in the Abu Dhabi initially,
Yes.
that is the vesting period, and when he exercised his right, he was in India. And then that would be taxable or not?
Yes, because if he's a resident of India, his global income is taxable. So
You see, they are totally scenario is different, right?
that's where he will have to claim the exemption under DDAA if he satisfies those conditions.
This case has gone beyond tribunal or?
No, it is not one. It is a very recent decision.
It has not
So
gone
we
to
don't know the status. I will have to check and get back on that.
So, I have a question. You mentioned the person was working with the Indian company.
He was employed legally by HDFC. He was deputed to a branch in.
Yeah. Will the
Okay.
ruling change if the RCC is working with the same group company, but maybe working for the US organization or the Europe organization?
Okay.
They're not working for the Indian entity, but it's the same group.
So here you're saying, is it going to be a separate entity? It's
Yeah.
a subsidiary that you're saying?
Not a subsidiary, let's say the European company, which is listed in any European market,
Okay.
have a subsidiary in India.
Right.
And the same concept where the
So the employee is an Indian,
yeah, the employee is in India and
working in India, working in
no,
US.
was working in India when he got the grant,
Okay.
but afterwards moved to Europe
Okay.
and is continuing working there, but with the European entity.
So there's a shift of employment, legal employment.
Yeah. Will when the exercise happens, Will this ruling apply to the person?
No, it won't apply in my view. I'll give the justification or reason for it. It's slightly different. The fact pattern is completely different here. There, because at the time of exercise or employment, he is employed legally by a company outside India.
Correct.
So there is no nexus with India unless he's an Indian resident, which we are assuming he's not.
Okay.
So because he's a non-resident, income is accruing arising outside India of a foreign company outside India. There is no tax in India.
Okay, but when he got the grant, he was an Indian resident and working for an Indian entity.
Correct. So that's where the question is of there is no taxability at the grant stage
Yes.
in India. Because there is no taxability at the grant or in fact even the vesting stage, assuming these are vested also, and we will go with another case which is a recent Karnataka High Court decision in Manjeet Singh Chawla. We will go to the fact pattern. So which is a similar case as you were trying to say, but not he was an employee of Indian community. We'll take in your example the reason why it will not be taxes. The Indian tax authorities only view the exercise as a first taxing event. Because at the time of vesting he was not an Indian and he is no longer an employee of Indian. If he was an employee of Indian, he is working on a project in Germany or in UK or in US, then my answer might be there is a slight tricky situation that we will have to evaluate. But since if he is an employee of the UK or US subsidiary or wherever he is, there will be no impact.
So in this tribunal, what happened? What is the status? Where we are?
So the tribunal has given a finding and has said that it is to be taxed in India.
On
The
what
purpose
basis?
is-
Sir?
Sorry?
On what basis? Because that's an Indian entity and the
It's an Indian entity.
The grant is when he's a
Yes.
resident of India and
Yes.
he's working out of.
He went outside India.
Okay.
At the time of event of exercise and at the event of sale, he was a non-resident.
Okay.
So then the question was, do you get, while the court specifically used the wording saying 1726 is only deciding the timing of taxation. It does not say when the income is accrued. The income accrual will be still covered by section 5.2, which is year on year whenever he is rendering the services. So they have used the same place where the services are being rendered or the employment is exercised is very important. Not just the state of residence. If he is non-resident, it doesn't matter in the time of exercise. Where did he render the service and where did he exercise his employment is very important. So that has to be evaluated in that fact pattern because he was in both the countries during the vesting period. The court said that no, you look at the option when he got these, you look at the options when he, you look at the taxability when he got these options in the year of grant or in the period of grant.
Okay. When he's rendering the service outside India also, indirectly he's serving the holding.
Exactly. So that is why he is exercising the Indian company. He is not serving as his case was that he is employed by a foreign company or a subsidiary there.
The vice
That would
versa,
have been,
that is vice versa.
yeah, that would have been different because it's a HDFC bank who has a branch there and he's only working on deputation there. So he was claiming exemption under Article 15 of the DTAA on dependent person, saying I am more than 182 days outside India. I am getting so, but however, the salary cost was borne by the HDFC Bank India. So that's where the court held that though you are outside India, non-resident, but you are rendering services to an Indian company on behalf of the Indian company. That's why they held it to be taxable in India. What are the practical issues before we go into one more interesting case of Karnataka High Court? The practical issues in foreign assets, especially ESOPs, is valuation because the reporting requires the costs, the reporting requires what is the market value, highest of peak value. So then what valuation do you use? If they are listed, it's easily available. If they are unlisted, what valuation will you take? Under UA or under FEMA or under Companies Act, which valuation will you take? There is RSUs, ESOPs, while income tax treats it at par, there might be different manner of taxation or different ways of reporting. So where do you report? How do you report? What happens when these assets are held in a foreign broker's account like Fidelity, E-Trade, you will have JP Morgan, all of those which hold as a custodian or as a repository. So how do you report them? What happens? So there is practical issues. There is no right or wrong answers. It is obviously case to case, and there has to be consistency in reporting. That's all what we can say. What are the risk mitigation strategies that we can recommend our clients or the SSEs? that there is a need for maintaining complete documentation. Grant letters, vesting schedules, broker statements. These have to be educated to our clients or to the SSCs, because while they receive this, they turn a blind eye, or they're not really aware of it. The HRs or the companies do not really make them aware of what was happening in terms of ESOPs. So if any SEC is getting ESOPs, it's very important for us to ask them to get all of the documentation, because this will be a question 3-5 years down the line, and they might not be working with that company. And thereafter it becomes a challenge, because what we see in litigation is they are no longer working with the company, and getting those nitty-gritty details or smaller details becomes a challenge. There is obviously educating payroll teams. If you are advising the companies that you please maintain, you give regular training, you have the documentation being sent out on the personal IDs so that they can refer back whenever they leave the organization. Disclosures and transactional data we have to report, because if there is a mismatch between our schedule FA and our incomes offered in the respective heads, we can expect a 143(1) intimation, and that can be a ground for scrutiny also. So we'll have to align our data so that we maintain consistency in the reporting. If we miss something or we come to know about something, it's better to do that we file revised returns, updated returns, or whatever is available. So there is a very interesting case. I am sure everyone would have heard this in news or articles. Flipkart, PhonePe, when the entire merger with Walmart was happening. So I'll give you the structure of Flipkart and the ESOP policy. So there's Flipkart Limited Singapore, which is the ultimate holding company, which is where the funds were raised, the $1 billion were all raised. It has a subsidiary in India, Flipkart Internet Private Limited. It's an indirect subsidiary, which basically is the Flipkart that we see and use every day. Similarly, they had a structure for PhonePe, wherein PhonePe India was held by FPS. And I'm just going to use Flipkart Singapore, Flipkart India, and PhonePe for ease of our understanding. So what happened when PhonePe was divested by Flipkart was, so employees, when they got ESOPs of FPS, the value was PhonePe and Flipkart both combined. So the value of the ESOPs were really high. And when they exercised, when they vested, or when they were not even exercised but granted, the employees were given to say, okay, I'm going to give you 1 lakh worth of ESOPs. Basically that was coming from 50,000 value was coming from PhonePe, and 50,000 was coming from Flipkart, just for example. So then, because of the divestment, the ESOPs continued of FPS, but the value reduced from 1 lakh to 50,000. And this diminution in the value of the ESOPs was a big challenge for the employees and the trade to happen, or the deal to happen. So what Flipkart decided was, we'll give a voluntary payment. So they gave a one-time compensation for the reduce in the value of the ESOPs that they were holding. So before the divesting PhonePe, the value of the ESOPs were 1 lakh rupees. After that divestment, because it reduced to 50,000, they said, I'll compensate it 50,000 by way of cash consideration. So a lot of employees got cash consideration. This question, obviously there was matter went to Delhi High Court first, where what is the taxability, whether this is a capital receipt, this is a perquisite, because the number of shares or number of ESOPs remain the same. I have not exercised anything. There is no change in the circumstances or value or anything, except the value of the ESOP getting down, and because of the value, there is a compensation which the company has given, though there is no right or obligation for it to pay. The employees cannot ask as a right, and the company does not have any obligation to pay. It paid out of its own will. So now, one of the SECs or one of the employees here was Manjeet Singh Charla. So he got certain ESOPs. He had only been granted ESOPs. Portion of it was vested, not exercised. Even though he did not exercise, because he had some grants given, he got some compensation. He applied for a 197 certificate relying on a Delhi High Court decision in Sanjay Bavija's case, saying, because this has been held in Sanjay Bavija's case to be not perquisite, please don't deduct any tax, give me a nil withholding certificate. The AO or the TDS officer rejected the 197 application, and the matter went to High Court by way of writ petition. So the background was obviously he got one-time compensation, there was no legal or contractual obligation, his number of ESOPs remained the same. The question before the High Court was, is this a perquisite? The compensation that he received by way of diminution of value of the ESOP, is it a perquisite? Is it a capital receipt? Is it a capital asset? All of these questions were there. Strangely, the same fact pattern, same employees of the same company, one in Delhi High Court gave in favor saying it's not perquisite, not taxable as perquisite. Madras High Court in the case of Mukesh Kumar Mehta said that this is perquisite and it is to be taxed as salaries. So there were two contrary decisions for the same fact pattern, same company. When the matter went to Karnataka High Court, the Karnataka High Court said that no, it is not perquisite, it is not even capital asset which is liable for capital gains. It is a capital receipt, exempt, not chargeable to tax because it fails the computation mechanism. And it overruled the decision of, obviously, basically distinguished the decision of Madras High Court and upheld the decision in Sanjay Goyal's Delhi High Court. Few interesting principles that the High Court laid down. So, Karnataka High Court. So, the first principle was that the FPS compensation is a capital receipt. Why it held a capital receipt? Because it said it is a voluntary payment. If there was no obligation on Flipkart to make good this value fall in the value of ESOPs. Typically, if tomorrow Amazon's market share crashes and everyone's ESOP value reduces, they are not obligated to pay anything. It's a risk that the employee also takes. So the argument was that since there is no contractual obligation, the loss is a voluntary payment. It is towards the termination of a profit-making apparatus of the employee, and therefore it is a capital receipt. It said that it is not chargeable to capital gains because it's a capital receipt. You have the full value of consideration, but you don't have the cost of acquisition. Relying on B.C. Srinivasa Shetty, it said that because the cost cannot be ascertained, it is not chargeable to tax as capital gains. On ESOP, it went to very specific. It said that it is not taxable as perquisite because the employee is never exercised. And what can be taxed is only on exercise. So when the law is very clear and it says it should be taxed only on exercise, an employee receiving any consideration without changing the shares, without changing the number of ESOPs, it cannot be treated as perquisite and there is no exercise. So there is no trigger that can happen under section 17(2)(6). Therefore, it said that the assessing officer was wrong in denying the 197 the nil withholding certificate, TDS lower deduction certificate that the SSC applied. So these were the interesting observations of the Karnataka High Court. It said that stock option is not a right. It's a right and not an obligation, because even if the ESOPs had been exercised or had vested, the employee has an option of not exercising, and since he does not exercise it, it cannot be treated as perquisite till the time he exercises it. And in fact, it went ahead to say that on exercise or on vesting, there is no taxation or no computation mechanism prescribed. And even if it is treated as perquisite, there is no computation mechanism, so it will fail. In fact, it went ahead and distinguished the Madras High Court on various counts. In fact, it says that the decision with the Madras High Court was anyway was challenged before the Supreme Court by the SEC, so it's pending. There was no computation mechanism under perquisite. It was wrong of the Madras High Court to conclude that stock option is not a capital asset, because the Karnataka High Court said it is a capital asset. It is chargeable under 45. Unfortunately, you don't have a computation mechanism and the cost of acquisition cannot be determined. So applying BC Srinivasa, it said that it cannot be charged to tax. It also evaluated this under IFOS to say, okay, it's not chargeable as salary, it's not chargeable as capital gains, can it be charged as IFOS? On that, the High Court said that once the charge under 45 is attracted but fails on the computation mechanism, you cannot now invoke it under IFOS because it is chargeable under capital gains. Just that you don't have a mechanism doesn't mean it can be taxed under IFOS. So while these are the decisions or these are the cases, how can it apply in a day-to-day life? I mean, this is a very edge case of diminution of value. Assuming some employee has ESOPs, these stock options are vested, and now tomorrow the company decides to cancel them. Now because of cancellation, they get some compensation because they were entitled to some shares. The company is saying, I will not give you shares. Now I will compensate you on lieu of shares. This happens typically with all those new startups that are going for listing. They either cancel those options to say I will not convert, or they convert them into shares. So for those who are probably going more private or in a private equity round, it's a very common phenomenon that employees get compensated for the ESOP by way of cancellation. So the question is, now because there is no exercise, can it be regarded as this consideration, can it be said as capital receipt? Is it chargeable to tax under capital gains? So these are larger questions that we can ask, or this is open for the floor to discuss and deliberate also, that is options that are not being exercised, what is the taxability of it? Because right now the law is not clear on it. I think I've come to the end, but I have a few more issues. I'll quickly just take another 10 minutes if you guys are willing to, otherwise.
Yes, a very interesting.
So there is a recent Supreme Court decision, it's as recent as 2 weeks back, in Hyatt International Southeast Asia Limited, which was on the context of permanent establishment. So this case, I'll just quickly take you to the brief facts. So there's a UAE company, Hyatt Group had 2 hotels in India, in Mumbai and in Delhi. And to manage and effectively operate those, they had a group company called Hyatt International Southeast Asia in UAE. So this was providing strategic oversight by way of the agreement called a Strategic Oversight Services Agreement, SOSA for abbreviation. So this was where they were looking into the strategic planning, brand oversight, HR policies, financial controls, overall management, to make sure that the hotel operates as per the Hyatt global standards. Similarly, there was an Indian entity, Hyatt India Consulting Private Limited, which was doing the day-to-day operations like hiring, operations, looking after the operation, technical assistance. The agreement was for 20 years, which could be extended for further 20 years. And these were signed in 2008. So the question was, the SEC, which is Hyatt International Southeast Asia, filed a nil return and claimed a refund of taxes because it said that I don't have a permanent establishment in India. What I am giving is a technical service. There is no article of technical service under India-UAE treaty. So therefore, there is nothing can be taxed under the treaty. I have no presence in India. I have certain employees who come and go, but they don't stay 9 months, so it does not trigger the service fee under the Article 5 of the treaty. And that was a claim made before the assessing officer. The assessing officer disregarded the submissions of the SSC, and it held that, you have a business connection in India under 911. What you're doing is both royalty and fees for technical service under 916 and 917 respectively. It said that it's royalties as per Article 12, because obviously there's no FTS under Article 12 of the DTAA. So it says that you have a chamber office of the MD which you have access to. Your employees are for a continuous period, though they don't cover 9 months, but they're more or less throughout the year. One of the other employee of your company is in India. So looking at all of those factors, it said no, you're taxable in India. Whatever incomes that you have earned in India should be taxed in India. The matter travelled to tribunal. Tribunal confirmed before that they went to DRP. DRP confirmed the order of the assessing officer. Matter went to tribunal. Tribunal said that it is royalties under Article 12 of the DTAA, as well as you have a permanent establishment in India because you have employees who are operating and managing the overall functions of the hotel in India. The SSC went before the High Court, Delhi High Court. The Delhi High Court said that no, it is not royalties. It ruled out royalties at least, but it said that what the Hyatt UAE is doing is in the entire functions of managing and running the hotels, and which is to be treated as a permanent. Basically, the hotel in India is a fixed place of business in India, and through this permanent establishment under Article 5.1 is attracted. In fact, it said that these employees who are deputed in India could have taken decisions for your other hotels. So you were using your India office to decide on other hotels also. It went on a presumption saying there is nothing stopping the SSC from using the India place of business for its overall business, and that's why it presumed that they were taking those decisions. The matter travelled to Supreme Court. Supreme Court recently, in the judgment delivered in July, confirmed the findings of the Delhi High Court, which was obviously after Formula One Championships decision in 2017. This is a landmark case for permanent establishment. So, what was the appellant's argument before the Supreme Court? The appellant first argument was, I don't have any physical presence in India. I don't have any exclusive office. I have come in India to give services which are strategic, which are more advisory. And for that I have to be in India. I am not there for more than 9 months in India. I don't have any fixed place of business. Therefore, no PE can be effected. I don't have control over the premise. I am not even a dependent agent wherein my employees are full-time here. I don't have a service PE. What I am doing is a preparatory and auxiliary services, which is only advisory or consultancy. I am not really involved in day-to-day operations because that's done by the Indian entity. So therefore, what I am doing is preparatory auxiliary, and I can satisfy the exemption under 5(4), which says that if you have a preparatory auxiliary, you don't have a permanent establishment in India. The last argument that they placed was, look, my UAE company is a loss-making company. Globally, I am a loss-making company. So even if you say it's a PE, there cannot be any income attributed to India because I am overall loss-making. The Supreme Court, relying on obviously the decisions and findings of the High Court and the lower courts, dwelt into the detailed aspect of the strategic oversight agreement. They went into details of the agreement to say, and one of the very interesting arguments of the SSC was, my services are very similar to chartered accountant services. If a chartered accountant goes to his client's place, works out of his finance manager's cabin and performs his services in relation to audit, it cannot be deemed that he has a PE because he's being in the office only to perform his services, and that's what we are also doing. So the appellant argued that we are in India only to perform the services as per the agreement and nothing beyond that. However, the court went into a critical examination of all the facts and the agreement. It said that, you have personal control. You are determining or you are deciding who is going to be the general manager. You have operational oversight. You will implement all the HR policies. You have control over pricing, branding, marketing. You have financial authority. You have resource who you're deploying here without prior consent of anybody else. Your fees are linked to the revenues done by the Indian entity. Your duration is 20 years, that means you're a long time, you cannot cancel the agreement. You can cancel the agreement, the Indian company cannot cancel the agreement. Your continuous business presence, all of these indicate that you are exercising complete control over the operations of the Indian hotel. And basis this, it concluded that the conclusions were that you have a fixed place of business. The hotel, the Indian hotel out of which you are working, is at your disposal. So it reaffirmed, it went into the Supreme Court decision, the OECD commentary, clause verbal commentary on fixed place of business. It reaffirmed all the principles of Formula One, whether there is the right of disposal, whether that premise is at the disposal of the SSC. The court held that yes, it is at the disposal of the SSC because you pretty much control the entire operations. It says that you're involved in the stability, productivity, dependence. Everything is dependent on the work that you do, which is a key attributes of a permanent establishment. So it also held that because you exercise actual control, supervision, right to use the premise during business hours, operational authorities, the right to disposal test is also met. Even on the attribution, it says that just because your global company is loss making does not mean that no income can be attributed to India. It in fact reversed the decision of Mukhya in Delhi High Court, and it held that this was a larger bench of Delhi High Court itself, which said that profits can be attributed as you will have to treat the Indian PE as a separate entity, and if it was rendering to a non-AEV same services, whatever profit that it would have made is something that will be chargeable to tax in India. So it held on the attribution also. This is a landmark decision because right now the way that the businesses are being run, especially in multinational companies, there is a lot of exercise of control, ownership, not directly or legally, but indirectly through operations. And these companies now can be under the ambit of a permanent establishment where they have to pay the proportionate amount of taxes in India. I'll just quickly take you through this because this is more of uh, everyone is aware of as I initially pointed out, BEPS Action Plan 1 was where the digital tax economy in India was the first to implement equalization levy on online advertisement and on the digital tax, wherein anyone who's rendering any online services in India, because of the customer base in India, you have to withhold or you have to pay 6% tax in India, and that income was exempt. This was coming out of a BEPS recommendation only, and India was the first one to adopt it because India is a big audience for advertisement, and they wanted to tap into and ensure that the Facebooks and the Flipkarts and Facebooks and the LinkedIns and everyone are charged to tax in India. Thereafter, there have been one more expansion on EL on e-commerce that was introduced in 2020, where similar thing was charged on e-commerce business done through India. There was also significant economic presence brought into 911. There was a global reaction, and this was pretty much dominated by the US. The US investigated under Article 301 of the unfair trade practices, and it was on the verge of sanctioning India to say that what you're charging out of 120 entities that you collect EL, 86 are based out of the US. So it's basically you're taxing me, and what you're doing, I will otherwise impose retaliatory tariffs. And at the same time, the OECD also was facing the same issue by US in various countries. So they came up with Pillar 1 and Pillar 2 approach to say, look, how are we going to tax? So India said that, okay, we'll adopt your Pillar 1 and Pillar 2, whatever the OECD is doing. They joined the OECD program on BEPS 2.0. They said that we will implement this. We will phase out EL completely by 2024, which was further extended to June 2024, and that was done. So in Finance Act 2024, after the government came to power, they abolished the EL on e-commerce transaction, and by Finance Act 2025, they abolished the EL on online advertisement also, because they made a commitment to the US saying that, look, we will stop charging you EL. We will now adopt OECD BEPS Action 2.0, which is basically Pillar 1 and Pillar 2. Pillar 1 says that if you are a 20 billion euro turnover company and you are having 10% profit margin and you are having some income from India, you will have to pay a portion of tax in India. So India was aligned with that. Second BEPS Action Plan 2 was, the Pillar 2 was that you will have a global minimum tax of 15% in any geography that you are working. So because India was aligned and US committed to this, India withdrew EL completely and it was abolished. However, now because of Trump, US is back out of OECD on Pillar 1 and Pillar 2. India is left hanging. There is a chance that this might come back into reality where India starts charging EL, especially with the way the tariff wars are going on. There is a chance that India might try to look at, because India is a big customer, there was about 4,000 or 5,000 crores worth of tax being collected under equalization levy every year. And now, if US backs out of Pillar 1 and Pillar 2, which is right now, currently as it stands, it has, then India might look at other alternatives to tax these companies.
In fact, it should be raised to 10% or 15%. Because they don't have option. They are the biggest consumers of this.
Correct. But most of the companies from the 2015 have changed the business model. They've got an Indian company involved. Basically, Facebook was the biggest, Facebook, Google were the biggest ones. So they have got the billing structure and everything to Indian entities, so that that exposure of 6% getting blocked and everything is, and they only fight on transfer pricing now. So, however, there are a few other companies and the global market is now expanding.
Go to transfer pricing, you have to pay tax on it.
Exactly.
So outside that is more than 6% is also that.
But the entire thing is then it becomes a separate business entity, the risks reduces, the litigation reduces.
Tax.
The biggest challenge of EL is that this is not allowed as a credit. It was levied by Finance Act. It was not allowed as a FTC under the treaty. The reason why US actually fought was this to say that this amount is a double taxation because this does not come as a credit to any country. And India agreed in BEPS action to say because this will be allowed as a credit going forward, such taxes, that's why they abolished EL. And in fact, Finance Minister made a speech when they introduced in 2025 to say we are doing this to align with the global OECD standards. Unfortunately, US backed out recently after the elections, and now we might see EL coming again probably if things continue this way. So I'm sorry I had to rush through the later part of it. If there are any questions, I'm happy to.
Second case.
foreign ESOPs, the SSC incurred losses, can we claim?
At the time of exercise,
At the time of exercise,
ah,
if he incurred losses, can we claim immediate?
so can you explain how would he incur losses? It might be at the time of sale. At the time of exercise?
No, at the time of sale, sir.
Yes, absolutely. So if a resident SEC has sold his foreign ESOPs, which has now resulted, basically when he got exercised, it was $500 the market price, and now today the market price has become $400. That $100 is allowable as a long-term capital loss.
There is no further procedure like when we are claiming the foreign tax.
No. Unless there is a withholding done even on that consideration, by which you can claim it.
Okay.
Sir, it is the international transaction, no? Loss where happened, how we can claim in India loss, capital loss.
He's an Indian resident. His global income is taxable in India.
If a non-resident has sold a house property, right, and he has purchased a house property, but he has failed to report in his FA and capital gains.
So, if I may just ask, where did he, non-resident, selling a house property in India? In India, because the status of the asset is in India, it has to be offered to tax in India. He's bought another property and you want to claim exemption. Is what I understand.
Yes, but he has failed to report in his income tax.
So that exactly, there is a default of non-reporting and the risk of non-reporting remains. However, when it goes to litigation, you can make a claim that the reason why a claim was or return was not filed because his net income was lower than the maximum amount not chargeable to tax and therefore there was nothing to be reported. But if you look at the requirements, you are required to report even if you are claiming a deduction under 54 or exemption under 54.
He has filed the ITR, but he forgot to report this transaction.
Exactly. So there is a default. The only default is you can explain that bona fide reason saying because you had already invested and you had satisfied the condition of 54F, there was an assumption that this is not chargeable to tax. So that is a plea that you can make before the assessing officer or in the assessment proceedings. Obviously what is done, you cannot right now rectify it. If there is a possibility of filing an updated return, you can do that.
What is the worst case scenario for that? I mean, what the department can do? We have pleaded, I mean, we have India, we have explained everything.
So there is absolutely, the worst case scenario is the assessing officer does not listen and the higher authority will listen. IT. Probably at an IT level definitely.
The thing that is moving out, it's coming up as an income escaping tax.
Exactly. So it will be under 148 that they would have initiated the proceedings. They will make a frame and order. They will also start initiating penalty proceedings. But this is a case where if you are able to demonstrate sufficiently that you have satisfied the conditions of 54F, and if it's done within the law, then it's much more easier. I think Commissioner will probably give you relief. If you're taking a stretched version to say you've not invested in CGS or you bought a house after 2 years, 3 years, and there's a default for the interim period also of the law, then it might be difficult. But at a higher authority, it should be.
It's just a reporting issue.
It should be. Thank you for being a patient audience. I understand it's been too late.
Presentation was very good.
Dear member, I would like to take a moment to extend our heartfelt gratitude to C. Ankit sir. Thank you, sir, for sharing your extensive knowledge and expertise with us. Your presentation was not only interactive but also engaging, shining light on the complexity of international taxation on the taxation today's rapidly evolving global economy. We appreciate the time and effort you invested in preparing this session. Now I request CA Umapati sir to kindly come to the dais and present a memento to our speaker as a gratitude and love and affection for this study circle meeting on behalf of Bangalore branch and all the members present here. Thank you, sir. Thank you so much. Thank you for attending this meeting. Thank you.